So this week we are looking at saving. We're going to go back and we're going to kind of revise this topic. We did it earlier in the year. So saving obviously is all about taking money to a financial institution, a bank, or a credit union, or maybe on post or something like that, somewhere that'll take your money. And as a direct result of them taking your money, they can give you interest back. So you can earn a little bit of money for your savings. So you've seen this before. Why do people save money? I'm just going to quickly go through bits of the chapter, but I want to focus on the calculating side of things. So savings are part of a person's income. Number of reasons why people save money. So to plan for future expenditure such as car insurance or household expenses, to plan for a holiday, and a lot of this is just thinking on the spot. Why would you save money? To buy a car, to buy a house, unplanned expenditure, maybe medical bills. If you're unsure about how much money you have and you feel like you need to save more money, then obviously it's a wise decision to do in case you have money worries. To be able to borrow money less often or not at all, to have money for retirement to earn interest. So obviously most of them are common sense in terms of having money for when you retire, buying a car, buying a holiday, a medical bill, stuff like that. Money saving tips. So cut back on discretionary spending. We would have seen this from our budgeting. It was cinema, holidays, entertainment, things that you don't need to spend money on. Cancel any subscriptions that are no longer used or wanted. So if you had a Netflix account or Amazon Prime account, Spotify, and you weren't really using it anymore, you could cancel that subscription. Well, obviously, instead of spending €8 a month, then you'd save that money. Gym membership, magazine subscription are here in the book. So use the cheapest method of payment in buying goods, for example, with debit card instead of a credit card where possible. And that's just because credit cards eventually, if you spend more money than you have in a credit card, if you overspend on a credit card, they will charge you interest. We've seen that briefly before. I wouldn't say it's as essential a money saving tip. Saving on utility and phone bill, maybe switching from Vodafone to Meteor or some other network or Tree, and downsizing where possible. For example, some cars have cheaper running costs, so the idea of having maybe a big 4x4, a big kind of Jeep car, which is maybe burning a lot of fuel, and you can buy a small efficient car instead. So what I really want to focus on here is savings accounts. So this here is a deposit account. So while putting your cash in a piggy bank at home can help you save money, it doesn't earn interest. So remember, when we take our money to a financial institution, such as a bank, on post, or credit union, they can reward us with interest for saving with them. So we'll go through what this interest rates will be and how we calculate it. So the savings account are known as deposit accounts, and they work by allowing the customer to save their money and rewarding them with interest. So if you can remember, there's two ways of calculating interest. We have simple interest, and we have compound interest. Simple interest is obviously the easier way of calculating it. It's simple interest. So just before we start this, interest is calculated as a percentage of the money in a savings account. So if I have €200 in my savings account and I have interest of 2%, 2% of €200 is €4. So it's calculated based off the money you have in your account. It's calculated off that €200. The amount of money in an account is called a balance. So that's the idea of checking your balance if you were to go to an ATM to see how much money you have in your account. So simple interest. It's calculated as a percentage of the original amount in the savings account. So as I said, if you had €200 in your savings account and there was 2% interest, you'd have €200 multiplied by 2% divided by 100. So Lila Shai puts €500 into a savings account in her local bank and leaves it there for 3 years. The simple interest is calculated at 5% each year. So break this down a little bit. So she has €500 and she has it in a savings account, and she is interested 5% per year for 3 years. So the first year she's €500. €500 multiplied by 5% divided by 100 gets us €25. So to calculate the interest, we multiply the amount she has paid in, multiplied by the interest rate, divided by 100. €500 multiplied by 5%, multiplied by 5 divided by 100. I'm getting 5% of 500 gets you €25. And try to think of it, when you get your answer, try to think of it practically. Does that make sense? Does that look like a fifth or 1/20th of 500? An easy way of calculating this out is this is worth 5%, so if I divided this by 5, multiply by 100, do I work my way back up to the original amount? Just a way of checking it, you don't have to do it. So I've got my interest is €25, and therefore at the end of the year she's earned €25 interest, so now her balance has actually gone up to 525. This is the start of the next year. Now she has €525 in. Her interest again is going to be €25 because it's calculated off the initial amount. It's calculated off the original amount paid in. And now her balance at the end of the year is going to be €550. That's her balance at the start of the year. Her interest again is going to be €25. Balance at the end of the year, 575. After 3 years, she's earned €75 interest. The quickest way to calculate this would be to put in the amount she has, €500, multiplied by 5 divided by 100, and then multiplied by 3. That'll calculate the interest for 3 years. But what you have to understand with simple interest, the big thing to take from this is the fact that the interest is calculated off the original amount put in. So the very first day we had €500, and 5% of that, if I multiply by 5 divided by 100, is €25. So the interest is going to be €25 every year. So if you were to do this for 10 years, it would be very easy. You just do 500 plus 25, 525. 525 plus 25, 550. You just continuously add 25 10 times. It's much easier to calculate compared to compound interest. But that's the most important thing with simple interest. It's the original amount multiplied by the percent divided by 100. And every year the interest stays the same. Now the interest does not stay the same in our next example. So that just reminding us here in the above example, you can see the interest is the same each year. There's always a percentage of the original sum. So that is my simple interest. We're moving on. We've looked at this before, and we're looking now at compound interest. Compound interest is calculated as a percentage of the total amount in the account at the end of each year. So what does that mean? We'll go through it here. So compound interest is the balance at the start of the year, whereas simple interest was the amount paid in for the first year. This one is the balance at the start of every year. Multiply by the interest rate divided by 100, so that part stays the same. So this time again, Carol puts €500 into a savings account, Carolyn, in her local bank, and leaves it there for 3 years. So again it's €500, and again it's 3 years, and again the compound interest is 5%. So the interest again is 5%, but this time it's compound interest, whereas the first time we looked at it, it was simple interest. So here's the difference between the two. €500 at the start of the year, that's our balance at the start of this year, multiplied by 5 divided by 100. Multiplied by 5 divided by 100. We always divide it by 100 and we're getting percents. And that equals to €25. Again, the same as the last time. Our balance at the end of the year is 525. Now from this point on, this is where compound interest changes. Instead of using our normal interest of 25 and putting that in 3 times, we're now getting our compound interest is the balance at the start of each year. So for year 2, her balance has changed. It's gone from €500 to €525. So now the €525 needs to be multiplied by 5 divided by 100, and that gets you 26.25. So the interest rate changes each year, and because our balance is going up a small bit each year, our interest rate is climbing a small bit as well. So at the end of the 3 years, once I've done this again, I've got my interest this year of 26.25, and I add that on, now I have €551.25. Again, it's the same thing. My new balance, because it's compound interest, we're compounding, we're continuously adding. €551 euro 25 multiplied by 5 divided by 100. So my new balance, I have to recalculate it, and that answer here is 27.56, €27.56 for interest in year 3. Now my balance at the end of the year is this plus this. It's €578.81. At the end of the 3 years, if we add up the 3 interest figures, we get a total interest of €78.81, whereas the total interest for simple interest was 75. It was just simply €25 3 times. But this has gone from 75 now to, sorry, let's go back to the page. It's gone from €75 now to 78.81. 75 to 78.81. So it's gone up €3.81. So she's earned €3.81 more than Layla. So the savings account that offers compound interest is better for the customer because the interest earned increases each year as the total amount in the account increases. And this may be a small increase, but over time it would get significantly larger. So compound interest for savers, there is 2 different words we can use for this here. It's the AER or CAR. So if you ever see a question in an exam that says calculate the interest for John or Mary using AER or CAR, it's the compound way of calculating interest. So it's our annual equivalent rate or compound annual return. So there's 2 different ways of phrasing it. The higher the AER or CAR is, the more interest the account holder earns, and that's just simple. Obviously, the more interest, this case was 5%, but if it was 10%, they'd earn more interest. So these rates differ between financial institutions, so there's always a good idea to shop around. So obviously, the higher this is, the better. If you went into a bank at the moment, you might find that Ulster Bank are offering 2%, AIB are offering 2.5%. An Post might be offering 3%. The credit union might be offering 4%. So obviously the one with a higher percent is going to be the more attractive one to have as a saver. So that's the compound interest versus the simple interest, and it is an extremely common question to come up in the junior cert, and obviously it's going to be important for first year summer test as well. So that's the simple interest and that's the compound interest, and remember the difference. The simple interest, you start with the original amount and the interest stays the same every single year. The compound, you have to calculate it at the end of every year. So you just add on the interest to your balance, and now you have to calculate it again. And then you go again at the 3rd year and so on. So that is the CAR and AER. There are 2 ways of describing it here: the annual equivalent rate and compound annual return. That's the way of calculating for compound. So remember, they're just another term for compound interest. Final bit here, just to finish up on it, getting a little bit more technical on this. So in terms of interest rates itself, we can have fixed interest rates. It means it stays the same for a set period of time. In the last case, the 2 examples were 5%. If it was a fixed interest rate, it means it would always stay at 5% for so many years. For a saver to receive a fixed interest rate of interest, they usually have to have a set amount over a set period of time. The other way of acquiring an interest rate would be a variable interest rate. So a variable means it can go up or down, so it can fall or rise. If the rate falls, the account holder earns less interest. If the rate rises, they earn more. It is possible to move savings to achieve the best interest rate. So variable versus fixed. Fixed basically means that if you go into a bank and you hand them €100 and you tell them, look, I want to start a savings account and they give you 2% interest, it's going to stay at 2% because it's fixed. But if you go to a bank and they're offering you a variable rate, it could be 2% for maybe the first year, and then after a couple of months of the next year it could change to 1.5% and you'd earn less interest. But then the following couple of months or the following year could go back up to 2% and then up to 3%, so you'd earn more. So the interest rate would be constantly changing, so it would depend on how much then that would obviously influence how much you'd earn. The final part of this is for tax. Sometimes people get a little bit more confused here, but it's just about being a little bit more patient with your calculations. So a government tax must be paid on interest earned on savings in deposit accounts. So when you earn interest in a deposit account, as we would have shown for the last two examples, your interest is actually taxed, and it's called DIRT, Deposit Interest Retention Tax. That's at 41%. So DIRT is a government tax on interest earned from a financial institution. So it's subtracted from the interest earned on savings, and this means that the interest account holder receives less than the interest their savings have earned. So now we're going to take tax into account, and we're going to look at a similar example. James Lynch puts €3,000 into a savings account and leaves it there for 3 years. So the AER, remember the AER, so sometimes they only tell you AER or CAR. They don't tell you simple or compound, but you need to be able to understand that CAR stands for compound annual rate, it's for compound interest, and AER, annual equivalent rate, means compound interest as well. So we see this here, that in this example, so he puts 3,000 into savings account for 3 years. The AER is 4%. DIRT is calculated each year at 41%. So balance at the start, €3,000. How do we calculate his interest? Well, James has put 3,000 in. It's at 4% interest divided by 100. So 3,000 multiplied by 4 divided by 100 gets us 120. So that's his interest. And normally we would add that onto the 3,000, and then we would say his balance at the end of the year was 3,120. But now we're taking DIRT into account, Deposit Interest Retention Tax. This is a tax on interest. So you only calculate this off of the interest. You do not calculate it off of the balance. So his DIRT and the tax is always at 41%. So I'm going to get his interest of €120, and I'm going to multiply it by 41%. And now this is a tax, so it's less. I'm going to take this away, because obviously if you earned €120 in interest and you were told you had to pay nearly €50 in tax, that tax would reduce the amount that you have in your account. You have to pay the tax. You no longer have that money. So he had €120, but there's €49.20 tax. So now his interest is only €70.80. So he's €70.80 interest. So balance at the start of the year is 3,000. Interest is €70.80, and now his balance at the end of the year is €3,070.80. Just adding the interest onto the balance. So year number 2, balance at the start of the year is €3,070.80. What are we doing here? We are doing AER. So this is for compound interest, annual equivalent rate. So we know we need to calculate the interest again. So now we have to calculate, we don't do the same €120. We have €3,070.80 multiplied by the interest rate, which is 4%, divided by 100. So 4% of this here is going to be €122.83. So that €122.83 is the interest for year 2. We have to get tax on that, and the tax, multiply this guy here by 41%. This time the tax is €50.36. I have to take that away. So 122.83 minus €50.36 gives me €72.47. So his interest at the end of year 2 is €72.47. I'm going to add that onto the balance at the start of the year 2. And at the end of the year 2, his balance is €3,143.27. So €3,143.27. Again, calculate the interest. I multiplied this by 4 divided by 100. His interest is €125.73. Tax on that is 41%. It's €51.55. And his interest received for year 3 is going to be €74.18. I'm going to add that onto the original balance. James finishes the 3 years with €3,217.45. So he had originally started off with 3,000 and now he's €3,217.45. So he's actually only earned these three interest figures, and they amount to €217.45. And he's paid off tax of 51.55, €50.36, and 49.20. So he's paid off, there's about €151, €150 of deposit interest retention tax. So that's how you calculate it. Again, this is the information you could be given in, let's say, a junior cert question. This is the amount of money they're starting with. They're doing it for this many years. You could be told simple interest or you could be told compound. They're the opposite. But sometimes they won't even tell you compound. They'll say AER or CAR. And you have to be able to identify that that stands for the, it basically means you're doing compound interest. And the final bit of information they've given us is the DIRT, the tax, and that's nearly always at 41%. So again, calculate the interest, you take away the tax. Tax 41% is calculated off of this guy only. It's calculated off the interest. And we do that for all 3 years. We make sure we add our interest at the end of every year, and we use that new balance to get our new interest figure, take away the tax, and now we have the interest for the year. I'm adding that onto the interest, or to the money at the start of the year, and we do the same for the last year. This is my balance at the start of the year. I calculate the interest based off that balance. I take away the tax on the interest, and I'm left with the interest received. Add that onto my balance at the start of the year, and now I have my final balance at the end of year 3.